Hi, everybody. So, we are going to do a little activity in a light week on just things that encompass and summarize what we've talked about with credit this past few weeks. And with credit, I have this little generic PowerPoint that I've used before and in a more traditional setting, of course. And we're just going to kind of go through a few things, and then I have a basic little activity for you to do. And hopefully, this really helps you understand credit and credit scores and why they might matter to somebody in particular or to most people, and why also, not having one, what that means. So we're just going to put all those pieces together and have an explorative week that's a little bit lighter and a little bit less traditional. Okay. So this is my first question. So are there similar characteristics between a GPA, or like the grade that you get overall at the end of class during each quarter or at the end of the school year, versus a credit score? Are there some similarities in that? And so here's an example. So if you take two high school students, Cheyenne and Noah, and Cheyenne's GPA is a 3.8, and Noah's GPA is a 2.7, and these numbers on a scale, like a 4.0 is considered typically from like a 90 to a 100. So a 3.8 is usually the late 80s. So like you're talking about like an 88 student typically. And then a 2.7 is probably like your 70s student. Anything below, oh gosh, I'm trying to think of the scale. Maybe below a 2 is usually not very good. But we can kind of pull that up later. But typically that's where you're at. But ultimately, what are we getting at here? Well, if we were to compare these two students' GPAs, Cheyenne's is better. Cheyenne has a higher average than Noah because 3.8 represents a larger number than 2.7. And that's the same idea for a credit score. If Olivia has a 600 and Lewis has a 750, then obviously Lewis is going to have the better credit score when you're comparing them. And some other similarities to think about with GPA is the higher the score, obviously the better. And the score is for one person. It only has to do with that person's actions. Okay. A GPA is one piece of information that the colleges look at when determining an acceptance, and that's what a credit score is. A credit score is one piece of information that creditors look at to determine if a borrower's ability and willingness to repay a loan. So the better your score is, that lets that person know, or that business know, or that agency know that you are either good or bad at paying back debts that you've had in the past or making payments on time. All those pieces throughout however long you've been doing things with credit have impacted the score. And the good things that you do with credit make your score go up, and the bad things you do, like missing payments, and only making minimum and not going above, like all these things are going to take a place in that score. So, what is a credit score? So, again, a credit score is a number, and it predicts the likelihood, or how likely you would be to pay that debt back on time as set, when you take out that loan or whatever it might be. Credit scores are used by employers, they're also used by insurers, potential landlords. There are actually some landlords that look at that number if you want to rent something, and that's because it's like a good piece of data, let them know you're going to pay them on time. And banks will use that number, and it assesses your risk level ultimately. Oh, are they going to pay me back? Well, let's look at their credit score number. Yeah, their credit score number is a 750. That's fantastic. I feel comfortable loaning you this money because so far it seems like you've been doing a good job. That's what the score does. Here's some facts. Credit scores are derived from credit reports. Okay, so where do they find these credit scores? They're on credit reports. The higher your score, the less risky you look, right? The better your score, they're like, wow, they're going to pay me back. And then the most widely used credit score that you might hear of is called a FICO score. So there's different types of credit scores, and FICO is the most used one. And then here's the FICO credit score range, okay? And you can see how they kind of scale it a little bit here. Think of it as a GPA, not so hot, right? Kind of like in the failure zone. You're doing all right. That would be kind of like your 65 student, right? You're passing, but it's still not as great. And then you kind of get into the 70s, the 80s, the 90s to 100. So that's kind of like if you relate it to a GPA. So that's kind of showing you how they look at it, and that lets them know how likely you would be to pay them back. So if your score was a 625, they're like, you're fair, so you may or may not get that loan, depending on how much it is, okay? How credit scores are calculated, so they're broken down into parts. Like for GPAs, you have tests and quizzes sometimes get put together, right? So your tests and quizzes are a certain category of your grade. You've got homeworks, and maybe projects are a different category. Just depends on the teacher in the class, right? So when it comes to the breakdown of your 100 possible grade, what percent is coming from where? And so you can see a big portion. This would kind of be like your test category for GPA. Comes from your payment history. So in the past, how have you been doing making your payments? 30% of it is how much debt do you have? Like how much do you still owe? That plays a part. The length of the credit history. So how long have you, so like this percent is going to be better for somebody that's been doing things with borrowing money for longer than somebody else. Okay. And then there's a credit mix. To be honest with you, not quite sure what fits in there, but I'm assuming if you're doing a lot of stuff with loans and borrowing money, when that person categorizes your numbers and it doesn't fit in the first three categories, then it obviously goes there. And then new credit. In the past few months, what are you doing with your credit now? Okay. What else do lenders look at? They look at credit reports, they look at your character, they look at capacity, and they look at collateral. Okay. What is a credit report? So this is not the credit score, this is the report, okay? Credit report is a statement that has information about your credit activity and current credit situation. A credit report will detail everything out for the person looking at it. It'll show your bill payment history, your current debt, and other financial information. What's not reported in your credit report, okay? So credit reports don't include your credit score. Credit reporting agencies use your credit report to calculate your credit score. So they use it to calculate, so your number's not actually on there. How are credit reports used? Credit reports help those lenders, so the person that you're trying to borrow money from, decide if you're going to get approved for a loan or not. The reports also help determine what interest rate they should charge you. So you're going to get a better interest rate the better your score is, obviously, right? And when I say better interest rate, remember, we want smaller, right? So if maybe somebody with a 750 credit score would get maybe a 5% interest rate, where somebody with like a 650 credit score might be a little bit more than that, maybe get like an 8% interest rate. So your score will also impact your interest rate that the lender is going to offer. Employers, insurers, and rental property owners may also look at this report. And how can you check it? So if you can get a free report yearly from one of these three sites, Equifax, Experian, or TransUnion, at annualcreditreport.com. Equifax, Experian, and TransUnion are credit report agencies, and they collect and maintain information in your credit report. Checking your credit report regularly is important to verify that your personal and financial information is actually accurate. Do you have a credit report? So how are credit reports created? A credit report is first created when you open a credit account for the first time and when the creditor reports the information to the credit bureau. So the first time that you say get a credit card, or the first time that you take out a loan for college, though that's going to open up reports with one of those credit bureaus that we talked about up here. Okay, Equifax, Experian, or TransUnion. Okay. So the question is, this is kind of what I just said. So have you applied for a credit card or a loan or a credit account? If you answered no, then you probably don't have a credit report. So many of you are going to fall in that category right now. 3 ways to build your credit. Secured credit card, so requires a cash deposit that becomes the credit line. A credit builder loan is a loan where the amount you borrow is held in an account while you make payments. And then retail store credit card is offered by stores such as gas stations, retail chains, and department stores. And you have to be 18 or older to open a retail credit card. So now what you're going to do is I'm going to open this up for you. This is the activity that comes with this lesson. You're going to look through this person's credit report, okay, and answer some basic questions to go off of it. Even if you've never used credit, it's possible that you've been a victim of credit fraud. So this is what's interesting. This can happen if someone has taken credit out in your name or used your social security card without you knowing. So this is actually pretty scary to think of with all these fraud and scams. Just because you haven't done anything doesn't mean somebody hasn't done something with your information. You can still check your credit report to make sure that something doesn't exist. Okay, so in that case, that could be where you guys fall. Okay, how can you improve your credit? There's 3 ways to improve your credit. The first way to improve your credit is to check your credit report and fix any errors and then know your credit score. Okay. Character, capacity, and collateral. These are 3 terms we're going to talk about. This is how lenders determine a borrower's credit worthiness, how likely they are to look at your score and say, okay, this is good. Character, will you repay the debt? Okay, so character is information that lenders gather about a borrower's willingness to repay that loan. So creditors will look at credit history, how much you owe, how often you borrow, okay, payment history, and your length of employment. So all of those things follow under your character, what you're doing as a person with this debt and with this loan and with this credit that you are paying back and that you had borrowed. So all those things go with your character. Okay. Capacity. So can you repay the debt? Capacity is the information lenders gather about a borrower's ability to repay a loan. So they're going to ask for your job. Okay. So capacity. Are you going to repay this debt? What's your job? Do you have income coming in? How long have you worked there? If if it kind of shows a history, even though it's not always, going to fully determine who you are, but if you're going job to job every few months, that might be concerning to this person. So, how long have you worked in one place? What's your income number wise? What are your expenses? What kinds of things? Where is your money going right now? Because if your money's going to all these things right now and you want to take out a loan, well, I'm nervous about that. I don't think you're going to pay me back because you're not going to have any money to pay me back because your money's already going completely into all these other pockets. And then any assets that you have, anything to your name, like do you own anything? And then the final thing that they look at is collateral. So collateral is a protection for creditors. If you don't repay them, what can they take from you? Because they're like, hey, you didn't do this. So they might see if you have any savings, property, and investment. Collateral, you'll see it a lot with like people that, that you're making payments on a car. If you don't make the payments on a car, they can just take the car back. A car is a great collateral. And that's why, too, you're more likely to get a loan out to take a car because a car can be taken back. Where other things, it's harder for them to get that money from you. And then what can't be used? Okay, so lenders aren't allowed to consider certain information when they're looking at your credit. They're not allowed to judge you based on your race, your color, your religion, your origin, your marital status, your age, your sex. Any of those things are not, those are all discrimination. Those things are obviously not judged and not looked at and not allowed for those lenders to consider when they're going to go figure out if they want to let you borrow that money or not. Okay. So let's take a little quiz here. So credit cards are charged to the maximum limit. Does creditworthiness increase or decrease? Okay. Uh, Credit cards are charged to the maximum limit. Creditworthiness will decrease. So maxing out your credit cards not only hurts your credit, but can make keeping up with the payments difficult, especially with interest charges adding up. So when you have a credit card, there's a maximum limit that you can spend. And they're saying if you do spend the max amount on that card, that's not going to help your credit worthiness. Are your bills paid on time? So if you pay your bills on time, what's that going to do to your number? That is obviously going to increase it. Bills are paid on time. Your credit worthiness will increase. Making payments on time every month will improve your credit score. If you recently applied for many credit cards, what's that's going to do? That's actually going to decrease your credit score. Too many accounts can indicate a risk. and can decrease your credit score. And that's because you've got so many pockets of debt that you need to pay back, and it's a little bit like too much. And then if you file for bankruptcy, that is also going to decrease your credit worthiness. So your payment history is the most important factor. And when you go bankrupt, that meant that you couldn't pay those debts back. So bankruptcy will decrease, obviously, your credit score. And if all your credit cards are maxed out, that will decrease your credit worthiness. In the eyes of most lenders, a person who has constantly charges all the money they can hitting or going over the credit limit is more likely to have difficulty repaying that back. Okay, so let's summarize some of the key terms that we've talked about. So credit score, the score is the number that predicts how likely you will be to pay back debts on time, and it lets the lender know that you're either a safe person to lend money to, a reliable person with good character, or and good credibility, or it's going to say, ooh, we're going to have to talk about this, or you're going to need a certain score before you can. A credit report, remember, doesn't have that score on it, but it's a statement of all of that activity. And then credit scores that range from 350 to 850, just like a grade. The higher the number, the better it is, the better that score is, and it represents that you're better at managing paying things on time and your debts. You can build your credit using a secured credit card, credit builder loan, or retail store card. And you can get free reports yearly from one of these three places at the official site, which is annualcreditreport.com. Okay. And then we've also got the three words here, looking at a borrower's character, capacity, and collateral. So remember, character is about your willingness to repay the loan, who you are as a person, how willing are you. The capacity is your ability, like, are you able to pay back? What's your income? What's going on here with your job? And then collateral is protection for the creditors in the event they are not repaid. What can they get from you if you don't make your payments? Okay, and that's that slideshow. So now you're going to have an activity to do. And if you have any questions or concerns, obviously feel free to reach out. Okay.